Hello. Welcome to the Money Knowledge channel. We are going to do something a bit different today. For my Canadian viewers, the Canadian federal budget was just announced last Thursday, April 7th. One of the interesting new measures is called a tax-free first home savings account. I have already had some friends asking me what that is. So I thought I would bring this timely information to you. This video is about this new proposed plan and what key things you should know about it, like its benefits, how much you can contribute, and how to make withdrawal. One important thing, to stay up to date with my latest videos and cool money management tips, make sure to subscribe to this YouTube channel by clicking the subscribe button. A tax-free first home savings account, FHSA. To help Canadians save for their first home, the Canadian Federal Budget 2022 proposed something new for first-time homebuyers in the budget announced on April 7th. And this will hopefully help Canadians save for a down payment to buy their first home. The government introduced the Tax-Free First Home Savings Account, FHSA, that would allow first-time home buyers to save up to $40,000 tax-free. Like a registered retirement savings account, RRSP, contributions would be tax-deductible. This means that you can reduce your taxable income with the amount that you put into the first home savings account. And withdrawals to purchase a first home, including investment income, would be non-taxable, like a tax-free savings account, TFSA. You will not be taxed when you take out money from the FHSA. This also means that the FHSA is tax-free in, tax-free out. The Canadian federal government is saying that they intend to work with financial institutions to make sure that a tax-free first home savings account could be opened and contributed to in 2023. So who qualifies for the first home saving accounts? To open an FHSA, you must be a resident of Canada and at least 18 years of age. In addition, you cannot live in a home that you owned at any time in the year the account is opened, or during the preceding 4 calendar years. This is to ensure that the account is for first-time home buyers. Individuals would be limited to making non-taxable withdrawals in respect of a single property in their lifetime. Once you have made a non-taxable withdrawal to purchase a home, you would then be required to close your FHSAs within a year from the first withdrawal and would not be eligible to open another FHSA ever again based on the proposed budget. Now let's talk about how much you can contribute to the FHSA. The lifetime limit on contributions would be $40,000, but there is an annual contribution limit of $8,000. The full annual contribution limit would be available starting in 2023. You need to note that the unused annual contribution room could not be carried forward. This means that if you contribute less than $8,000 in a given year, you would still only have an annual limit of $8,000 in subsequent years in the future. This can be a bit confusing because it is different from RRSP and TFSA, where the contribution room can be carried forward to future years. So if you are intended to fully take advantage of your first home saving account, you will need to make sure that you contribute $8,000 in the year. And again, there is a lifetime limit of $40,000. Given the lifetime contribution total is $40,000, and it will take 5 years of $8,000 per year to fully top it up if you are able to. The first fully topped-up accounts will occur in 2027, assuming the accounts will be available in 2023 as suggested by the government. You would be allowed to hold more than one FHSA. For example, you can have one FHSA with Bank A and another FHSA with Bank B, but the total amount that you contribute to all of your FHSAs could not exceed the annual and lifetime FHSA contribution limit. Now, after you save and invest in the FHSA and at the time that you want to buy your first home, you would want to withdraw the investment out. Like I said, amounts withdrawn to make a qualifying first home purchase would not be subject to tax. But please note, any amount that is withdrawn for other purposes would be taxable. But what if you start at FHSA but then later decide not to buy a home? The government provides flexibility for this. You could transfer funds from an FHSA to an RRSP at any time before the year you turn 71 or to a registered retirement income fund, RRF. Transfers to an RRSP or RRF would not be taxable at the time of transfer, but amounts would be taxed when withdrawn from the RRSP or RRF in the usual manner. Transfers would not reduce, or be limited by, your available RRSP room. Also, withdrawals and transfers would not replenish FHSA contribution limits. There is another point that you should note. If you have not used the funds in your FHSA for a qualifying first home purchase within 15 years of first opening an FHSA account, your FHSA would have to be closed. Any unused savings could be transferred into an RRSP or RRF, or would otherwise have to be withdrawn on a taxable basis. Canadians would also be allowed to transfer funds from an RRSP to an FHSA on a tax-free basis, subject to the $40,000 lifetime and $8,000 annual contribution limits. These transfers would not restore an individual's RRSP contribution room. So if you have already saved money in your RRSP account, you could use this to contribute to your FHSA and enjoy tax-free withdrawal from FHSA when you buy your first home. One note about the existing Home Buyers Plan HBP. While the Home Buyers Plan, which allows homebuyers to withdraw from RRSPs to purchase a home, will continue to be available as under existing rules, you cannot use both the Home Buyers Plan and the FHSA for the same home. This is it. This is the newly proposed First Home Savings Account. What do you think about it? Do you think it could help you? Tell me in the comments below. I would love to hear about your thoughts. To stay up to date with my latest videos and cool money management tips, make sure to subscribe to this YouTube channel by clicking the subscribe button if you haven't already done so. Until next time, stay safe, happy money management. Thank you.